You don't have to use it, but
Can you guys hear us?
I think you're all right. Yes.
Okay. Hello, we are the University of Idaho team. My name is Shay Davis. This is Nicole Smith, Colton Gray, and Brennan Anthony. Today we will be discussing Red Lion Hotels.
So Red Lion Hotels is a micro-cab hotel operator in the lodging industry, and they've been in the business for over 50 years. Over the past 5 years, the company has underperformed compared to both the broad market and the consumer discretionary sector. But since 2016, with key management changes and also a revised strategy that's been carefully implemented, the company's stock has seen better performance. And so with their asset-light transformation, a push to become a franchise of choice for franchisees, continued technology integration, and an aggressive expansion into the asset-light world, we recommend that Red Lion Hotels is a buy at a target price of $10.68, which represents 70% upside.
In 2016, Red Lion's revenue came primarily from company-operated hotels. Since then, they have been transitioning to an asset-light model where they will be focused away from company-operated hotels and more on franchise properties. They have announced the sale of 11 of their 18 properties, and this revenue will need to be replaced by franchise properties through acquisitions and individual franchisee contracts. The sale of these properties will result in a reduction of their operations and maintenance costs, as well as freeing up capital. And the cash generated from this sale will be used to pay off debts and pursue acquisitions. Here you can see Red Lion's franchise hotel growth. The largest growth was in 2016 with their acquisition of Vantage Properties. With the implementation of their aggressive strategy, we think that you can expect double-digit franchise growth in the near future.
So we use Porter's 5 forces to analyze the lodging industry. There are many competitors in the industry, and they all essentially provide the same service. The demand for hotels is primarily based off consumer discretionary income, and there are many suppliers for the services that hotels purchase, such as web services. And the barriers to entry in the lodging industry are very high because of the difficulties to achieve economies of scale and develop a quality brand that will attract franchisees. So some of the key industry trends we are seeing is the use of technology to personalize the customer experience, and also the industry is heavily reliant upon mergers and acquisitions to spur franchise growth. A key threat is online accommodation competitors such as Airbnb, which can compete at lower prices.
So here you can see Red Lion's top competitors as well as their revenue per available room, which is a common revenue metric used within the hotel industry. Red Lion's RevPAR is lower than Marriott's and Hyatt's, primarily because they operate in a lower price segment of the industry. We believe that as middle class discretionary income improves and millennials start traveling more, there is upside potential for low to mid price value options such as Red Lion.
So there are many key factors that influences Red Lion's competitive advantage in the industry, and the first of which is a franchisee-centered philosophy. So they do offer a variety of different, whether it be economy level hotels, all the way up to upscale hotels for the franchise owners to choose from and kind of get a little bit of a diversity in that sense. They also offer very low upgrade requirements for those franchises, which is a little bit different compared to some of the other competitors in the industry. Red Lion does have a lot of room to expand in the business as well, especially since they are competing in a little bit of a oversaturated market where a lot of their competitors aren't highly differentiated at all. They also utilize the RevPack software, which is a customer relationship management database. It helps with anything related to guest services or consumer retention or, helping the front of the house talk to the back of the house kind of a thing. In addition to this, they also have a partnership with Expedia, which is an online travel agency. It's not something that we see with a lot of other competitors in the industry, so it does set them apart in that sense. As of recently, they are focusing a lot of their branding efforts towards a millennial-based basis. This is kind of interesting because it is a little bit of an untapped market in the lodging industry, and especially as we start to see some of the more the middle-class citizens have a higher discretionary income, they might be interested in hotels of Red Lion's nature. And then lastly, Red Lion has a combined over 150 years of management experience in the lodging industry. So therefore, because of these reasons, we believe that Red Lion will have a really good competitive advantage to achieve our target price. So these financial ratios really illustrate Red Lion's current transition that we were kind of mentioning a little bit before. There is a cost to transforming your business structure, and that's especially shown here in the negative profit margin, especially as they start to sell off some of those company-operated hotels. They aren't able to recognize as much revenue. And so with the liquidity ratio, this is actually kind of nice to see. They do have a lot of cash on hand to pay off a lot of these short-term debts, so it is a little bit higher compared to the competitors. This is shown again in a low debt-to-equity ratio relative to their competitors here. And then finally, their EV over EBITDA ratio is also lower compared to the competitors, which is also very reassuring to see that, you know, they have higher relative earnings compared to some of the other people in the industry.
To arrive at a price target of 1086, we use a combination of a discounted cash flow analysis and a real options model. We use the discounted cash flow analysis to value Red Lion as an investment, and we use the real options model to account for the future structure of the business. So by switching to a franchise-based model, Red Lion is going to have increasing positive cash flows throughout the year. So we based their 2017 free cash flow off the first 3 quarters of 2017. And we projected high growth rates for these cash flows because of the relatively small 2017 free cash flow relative to their sales, and because of their increasing transformation to the franchise-based model. So we arrived at a share price at 11.01, which is consistent with our real options-based model.
Yeah, so we used a real options valuation as more of a proxy for the future growth than where we see Red Lion when they fully transitioned into an asset-light company. Because we didn't feel like our discounted cash flow, though it incorporated some of that future-looking transition change, we didn't think it was fully represented by purely discounted cash flow. So we used a 10-year maturity in order to be in line with our discounted cash flow assumptions, as well as a risk-free rate that was equal to the yield on the 10-year treasury. And with that, we arrived at a value per share of $10.68. And then we had a weighted average using 60% of our discounted cash flows, 40% real option valuation, and that is how we arrived at our final target of $10.86.
Okay, now I'm going to discuss some of the top investment risks for Red Lion. They are currently competing against online accommodation competitors, though they have been able to effectively utilize technology to reduce the negative impact of this competition. A poor real estate market would affect their ability to carry out their asset-light transition, as it would limit their ability to sell off their properties. However, they have announced successful confirmation of 5 sale and purchase agreements so far this year. Low tourism would also hurt Red Lion, as it would reduce demand from both hotel guests and franchisees. However, the U.S. economy is strong right now, and we believe that it will continue to spur tourism, especially among millennials and middle class.
So kind of in conclusion, with the asset-light transformation, it shows that Red Lion has a very proactive management team that's very focused on, watching the company grow and seeing a lot of growth potential there. They are maintaining the franchise of choice in the sense that they offer a variety of different franchise options to the franchisees and low upgrade requirements as well for them. They do have very strong technological integration with the RevPAC software, with the partnership with Expedia, like we were mentioning before. And then they have a ton of growth potential and expansion in the future, especially as they begin to build up cash stores with these sales on company-operated hotels. That could be a potential target for an acquisition in the future, which would look very good for investors as well. So therefore, because of these reasons, we believe that Red Lion is a buy with a target price of $10.86, which represents a 7% upside. So thank you so much, and we'd like to open the floor to questions.
Sure, thank you. So they have 7 hotels left to be sold, is that correct?
Yes.
Okay, and estimated proceeds and use of those proceeds, what would you expect that to be? Is there a ballpark there, and then how are they going to redeploy that capital?
Yeah, so they haven't actually released what their proceeds for the original 5 hotels that just had the sale and purchase agreements are yet. They said that they arrived at single-digit cap rates, which means that overall their goal was to receive $100 million for all 11 of those properties. And so they were saying that these single-digit cap rates actually exceeded their expectation. So based on that, we won't be able to actually determine exact estimates until they release what those cap rates are. But we would expect closer to 150 million of that, which then they could use to fund acquisitions in order to give a little bit more key money to current franchisees to start building that brand recognition.
So that 100 million was for the 11?
Yeah, for the total 11, and
Okay.
they had 5 already.
Okay, they've done 5 of those 11.
Yes.
Okay, and any thoughts or commentary about the debt, using that for debt pay down, or is that something that they're just comfortable using that more on the acquisition side?
I would say that Redline has a really good policy on debt pay down right now, like how we were mentioning before, where they use a lot of their current assets like cash on hand to pay off their short-term debts. So I would say that it would be more geared towards acquisitions.
Okay, alrighty. And go ahead, Craig. I'll come back.
Can you explain to me what they're receiving from each franchisee in terms of their revenues per hotel or per room?
Yeah, do we have a slide on that? Okay.
I didn't hear you wanted to know the for the
revenue,
franchise owners, what their proceeds are?
what they're receiving from the franchisee. What's the rate that they're receiving per hotel
So
or per room, whichever
From-
metrics you have?
So from what I know, it depends on the quality of the franchise that they get. Like if they get a economy level hotel, it's obviously going to be much less RevPAR compared to an upscale variety of hotel. I do know that part of the proceeds that they get, they have to pay royalties to Red Lion for. I don't have an exact number on that though, but it's something that we could
So
certainly.
revenue for available room is at a range in the low 20%, going to Red Lion for the comfort level is at economy, all the way up to high 20s and moving into the 30s for hotel RL and the upscale brand. And so it really is a range that's in their family of 9 different brands. And they're looking to use the RevPAC software and the data analysis that comes with that to help teach franchisees how to better use all the tools at their disposal in order to increase that revenue.
Okay, well, let's talk about just top line revenue then. What are your revenue growth expectations in your model?
I think we can expect maybe 10 to 20% revenue growth. I think they were around 10% this year. So I think it's reasonable if they are able to fully commit to this and gain more franchisees organically and through acquisitions. I think 10% probably seems reasonable.
How do you get to a 10% revenue growth? Going forward, you're looking at 5 to 10 years on that revenue growth. Is that right?
Yes, 5 to 10 years.
How do you get that 10% revenue growth?
Just by constantly acquiring other franchises, gathering more more brands, and that should be able to increase their basis if they're able to just increase that franchise number.
I wanted to jump in just real quick on that too. First of all, it's more focused towards franchise type revenue. So as we were talking about earlier, they're selling off a lot of their company operated hotels. So that revenue segment is going to be deteriorating throughout the years. But we're predicting, high franchise revenue growth. But yeah.
So what do you guys think? I actually noticed in their last quarter that their actually company-owned hotels division did 18.6% in operating margins versus their franchise hotels did under 16%. Why do you think they would be selling their lower operating margin business and taking those resources and allocating them to the lower margin operating business on the franchise?
I can grab that one. So as Shay was saying, a majority of their acquisitions and their franchisees were acquired in 2016. And so as part of that learning process, as they work to integrate 1,000 new properties and the franchisees that own those and are working with them into the system. Red Lion has had over 50 years of experience operating their own hotels, which means they're a well-oiled machine when it comes to being able to extract the maximum operation revenue and operation margins. But they see the future in franchises. And so that just means working closely with their franchisees and software that they have.
So there's scale to the franchise business.
Yeah.
Okay.
And it's just a learning and a transitory period. Any business would struggle multiplying tenfold in their franchisees and maintaining very high margins. So.
Yeah, and I have one follow-up, and then Rich can take it from here. So you notice with your guys' price target, with an upside of 7%, that's not a lot of upside in terms of going out and buying a stock. So is there a lot of conservatism in your guys' model? Because even if you take your risk-free rate from 2.5% or 4% to where it is today at 2.8, 2.9, maybe the markets have been volatile last week. But do you have something that maybe it's more of a hold than a buy, or is there just conservatism?
Yeah, so I think that we are relatively conservative. We also kind of have to factor in the idea that they could be a target for acquisition, which could provide higher upside in the future.
Could you touch on industry supply in the markets that they operate in? I mean, it seems as though, between what's happened with new supply from the VRBO and the Airbnb side, but there's also been what appears to be a lot of new construction in many markets. Can you just address that, and how are they positioned in each of those markets?
Yeah, so Redline really has to try to key in on like the millennial, try to refocus their brand and sort of differentiate themselves from companies like Airbnb, which could provide a lot more personalized homes for people to stay in. So they're having to just separate themselves differentiate-wise and also differentiate the risk among the many brands.
And following up on what Colby said, and the overall lodging industry is growing pretty much at pace with the growing of private accommodations such as Airbnb. And Red Lion, because they're a smaller franchise, has the ability to move into markets where maybe Hyatt or Marriott brand hotels are oversaturated, because in the brand scale for Hyatt and Marriott, there may be 3 or 4 around a corner, and then those franchisees are unable to really have flexibility with pricing options because they can't compete against the other franchisees that are working under their same brand umbrella, which gives Redline a chance to go in and pitch more competitive pricing, more flexibility, because they're under a different overall brand to be able to have maximum revenue for the franchisees.
Okay. What about inside ownership and share purchase from the management team? Have you seen much of that that's been going on? And can you give us an idea as to how much management owns?
I don't have the exact numbers on that. I know that there isn't a lot. There are like inside members on their board and stuff, so there is the disconnect there. Yeah.
I do want to just jump on that real quick too. For looking at the institutional shareholder view, the last time that we checked it, no one had owned more than 7% of the shares for institutions. So it's a very, very it's a small portion of most people's portfolios. It's very well diversified in that sense.
I'm trying to get 2 minutes. Okay, can somebody explain to me how you came up with the $232 million option value for this company?
Yeah, so we used the strike price as the overall debt level, and then the mark as the overall asset market value based off their Q3 balance sheet. And then with the risk-free rate and maturity, and then we also used volatility of, what was it, 4, 9, which was, then using a Black-Scholes model in order to value that, we came to the total amount and then divided it by the total number of shares out to come up with the value per share.
Is that conventional calculation? Because what if this company had 0 debt? How do you use a strike price?
Yeah, so we felt that for Red Lion, with their transition into asset light, and they're going to move to have a lot more cash and assets and writing off some of that long-term debt, that even though this is an unconventional method, it fit where we saw the company was moving forward into the future. And until they get rounded with that asset light transition and are able to use more conventional methods, this was our best proxy, looking at different valuations in order to be able to encompass kind of the greatest amount of factors into it. And so even though it might seem oversimplified, we really like the compare. Okay, thank you. Yeah.
Thank you.
All right, very good.
Yeah.